With only 11 trading days left in 2025, Wall Street is wrapping up another very strong year. All four major averages are up double digits. The Nasdaq is up 20%. This is for the third year in a row. Can this rally continue, or will 2026 break the market's recent run? Well, maybe this week can provide a glimpse for evidence for both the bull and bear cases. On the bull side, we have seen improvement in the breadth. It's more than just tech. Financials, industrials, transports, if you dig into industrials, starting to take leadership. We also got another rate cut from the Fed. Both of those coming with the consumer appearing strong this holiday shopping season. Now let's look at the bear case. Fears the AI trade got ahead of itself, as evidenced by those Oracle reports we just discussed. And yes, the Fed did cut, but it didn't forecast many more cuts for next year, only one on the dot plot. And the bond market is actually sending yields higher, particularly longer end of the curve, as you just heard Rick Santelli talk about. Signs of weakening in the housing market. Home prices went negative nationally. Add to that the CEO of RH saying that this is the worst housing market in almost 50 years. So joining us now is HSBC Global Private Banking and Wealth Management CIO Jose Rasco. Jose, it's great to have you on. And that's exactly where I want to start with you. This push-pull between the bull-bear case and specifically why you are firmly in the bulls camp looking to 2026.
Yeah, and it's sort of scary to see you between that bull and bear, Morgan. I'm concerned for you. But long story short, look, I think if you look, the Fed, the Fed's probably not going to ease a lot more. We don't have them easing at all. They have them easing. They have themselves easing two more times. Well, we're going to get a new chairman next year. Let's see what happens. More importantly, remember the 90s. The Fed funds rate averaged 5.3%. We had four bull markets and a great tech revolution. So the Fed helps on the margin. Lower rates would help. Higher long rates don't help housing, but they're not going to resolve the housing inventory problem anyway. You would need much lower rates for that. You need more supply. And I think if you look at the market, this steepness in the curve that Rick talked about, that's why we like financials. They make all the sense in the world at this point in the cycle. And when it comes to that tech story, it is a re-rating of tech, a repricing of tech. And the Oracle story today is fascinating. It's exactly what we've been talking about for months, right? I've been saying for a while that I think tech needs to be repriced because not that the multiples are too high. Multiples are too high given the logistical constraints they're going to have in building out quickly. And more importantly, you're seeing that AI is not a U.S. only phenomenon. It is global. And that's going to push demand even higher.
So I want to dig into that a little more deeply here, Jose, because you argue that this AI repricing is not done. Does that result in a rotation into other sectors of the market, as we saw earlier this week, or a pullback of the markets more broadly, as we saw to a certain extent today?
Well, and that's the risk, right? If this goes really wide, we run the risk of markets selling off more broadly. We don't think that's going to happen. I mean, don't forget, earnings were 10% last year, 12% this year, 14.5% this year, based on the FactSet consensus numbers. So we see not just strong numbers, we see an acceleration in earnings. And given the price increases we're going to see in computing and in chips next year, you should look for higher margins than that, Morgan. And more importantly, I think you have an economy that's stable. And there's a mismatch between the equity markets, the overall economy, and the labor markets, no question about it. But let's not forget the asset price inflation we've had as all this money is poured in due to FDI since 2018. That leads to asset price and goods and services inflation to some degree. But we think it's stable inflation. So Jose, the AI reprices to reflect slower growth in the short term, but the tech cycle expands and the duration extends.
Is it really just a logistical constraint issue there when you look at the AI trade? I mean, there's this sentiment shift, it seemed, that's potentially there on whether OpenAI, maybe others, are good for the money in 3 or 4 years based even on demand, right? When you're projecting billions, hundreds of billions of dollars worth of spending based on what demand for their product is going to be, that's quite a story to have to live up to. Is there whole market impact based on that kind of projection of what the demand's going to be?
Well, John, you hit the nail on the head. If we're going to spend trillions building data centers so I can write term papers more quickly, we just wasted a lot of money. That's not what AI is. AI is a productivity enhancing tool on both sides of the balance sheet. LLM models were the entry. They were that entry point. It's like plugging the computer into the phone line. That was not what the internet was about. The stocks that are going to be the AI winners we haven't even produced those companies yet. I think this is a multi-year tech revolution. If you look at empathetic AI, look at agentic AI, look at what that's doing to both sides of the balance sheet, it is going to be revolutionary and well worth the expenditure. Now, we do run the risk of an overbuild, right? That's always the case. And on the margin, you'll probably see some of that in 3 to 5 years, no question. But the overall spend, well worth it, going to lift productivity. And remember, the Amazon effect from the last cycle, right? Amazon was killing the retail economy, and we did lose 300,000 jobs. We added more than 1 million in logistics, distribution, warehousing, and real estate, higher value added, higher paying jobs, and they push multiples higher. So I think that's the key here is we have to be patient.
Right.
And as this goes global, it creates more of that logistical problem.